Okay, great stuff. So, chapter 9, financial financial instruments. Let's begin. So, um, really, what we're dealing with here is that we're dealing with a new set. Well. I'll be cautious there. What's really driven this standard, really, are the new types of instruments that we're seeing. We've always had financial assets and liabilities. I mean, loans, debentures, equity. These are all financial instruments, and we've always when we talk about these instruments, when we talk about these relationships, we have to discuss how we recognize them and how we measure them year on year. Many of these will last over a period of time. So the question is, how must this recognition occur over a period of time, given these external variables of interest rates, if you like, or technically you would argue is the cost of borrowing money. And therefore, if someone's going to be lending money, someone must be receiving some interest. And how do we recognize that interest? On an accrual basis, which is the fundamental underlying principle, if you like, an underlying assumed principle, isn't it, of financial accounting. Of course, this is, when I say the accrual basis and interest, I'm talking about loans and debt. The question of equity now is, we're not talking about interest here, we're talking about dividends. Fair enough, but in terms of the recognition of the asset itself, in terms of valuation, subsequent recognition, what happens after you first of all buy a number of shares? And so that's what the standard kind of addresses. Right. So again, like I say here, so a business can be holding on its balance sheet a range of debentures. Debentures are just long-term loans of businesses where you've issued, I'll start with that word, if you've borrowed money. So the technical term, sometimes language is so important that you're happy with the language. The fact that you have borrowed money, if you're borrowing money, you literally will issue or release an IOU note saying that, listen, I, Mr. Tesco's, am borrowing money from Mr. Oyen, and I'm therefore issuing Oyen with this piece of paper that says I owe Oyen, whatever it is, £10,000 plus interest, if you like. What's typically referred to as a coupon rate, and I will pay Oyen, if you like, for his money, and for thank you for giving me your money, Oyen, I will pay you interest on that amount. Say, for example, at 10% every year. So this 10% is referred to as the coupon rate. I only found out a while ago that really it could have been that apparently somewhere in Arundel you have these bond sort of these pictures with these they still hold sort of memory of what coupons really look like. So you have a piece of paper that literally has, say, for example, in this case, £1,000 on it. So literally every single year, I'll turn up. These would be sitting on the IOU note, and I'll turn up with this piece of paper, hand it over, and I'll get £1,000. Turn up, I'll get £1,000. Turn up, and you see, I'll get £1,000 for however many years I'd lent them the money. So so that's kind of the first thing. So typically, a business can be holding on its balance sheet a range of debentures or whatever, or any assets and equity, if you like. And typically, of course, we'll see here that, if I'm holding a financial asset because I've lent you money, you're holding a financial liability. So there's a contract. There's a contract where you will pay me a certain amount of money and I will receive a certain amount of money from you. So these financial instruments are, if you like, contracts in effect. So there must be a contractual obligation. Someone will be giving money, someone will be receiving money at some point, if you like, even if it's not regular. At some point we have a contract, there will be an exchange that will end up being favorable to one of us and unfavorable to the other. Right. So again, we have such a plethora, a huge growth in the variety and complexity of financial instruments in international financial markets. And what we haven't seen is this sort of balance, if you like, in how we recognize these instruments. And these standards are have really been brought in, if you like, to manage the complexity, the volatility of whether we recognize profits and losses immediately, do we wait till the end, and that sort of thing. And sometimes you have assets where you've not actually paid anything for, but do you recognize it straight away? So, this is what I'm saying here, that they were more complex. There are particular problems, in particular derivatives. I mean, derivatives, you'll come to see that these contracts that give you the right, if you like, to an asset, or the right to, typically, or a cash flow, if you like. And in effect, the question here is that because you weren't paying anything, because many derivatives in some capacity sometimes don't even have any required you're acquiring an asset, but you're not releasing any funding immediately. The question here was, when did you actually recognize this financial instrument? Because it was observed that many financial instruments weren't being recognized. So, or we noticed that companies were choosing when to recognize these so to smooth out their profits. So anyway, we have IAS 32, which has been around for some time, which has really been there to help us with the presentation, so to speak, of these assets. And IFRS 9 really gives us advisory on how we actually deal with these. And in terms of the disclosures, we have IAS 7. And you can imagine you would need, in terms of disclosures, you would want to know everything that's going on with this asset. So I will be using the textbook a lot as well. IAS 32 deals with the classification of financial instruments. So sometimes you have this debate about whether something or not is asset or is equity or is liability, just because of the nature of the relationship. And of course, IAS 32 gives us this kind of, how do we present this? Do we present it as equity? Do we present it as liability? So for example, I mean, if we know what the characteristics of equity are and what the characteristics of liability are. With liability, we're expecting regular interest and our money back. With liability, we aren't expecting regular interest and we aren't expecting our money back. So it's more about the substance, really, of the relationship as opposed to the legality. So technically, you could be obliged, contracted, to pay someone back in your equity shares. You could say, listen, I'll buy something from you, debit whatever asset, debit inventory, and I'll pay you back in shares. And I'll issue my shares to you, if you like, in whatever 3 years time, immediately, or whatever it is. So you can see that really I have an obligation to pay you in shares. So it is an obligation, it is a liability, even though I'm paying you in shares. I could borrow money. If I'm going to borrow money, I could call it equity, but I could say, okay, I'm going to give you these. Might see it in a second here, but I'll just talk about it here. So when I come across that slide, I'll move faster. If you remember, we have this idea of preference shares, and preference shares, you have redeemable and irredeemable preference shares. So irredeemable preference shares, there is no obligation to ever pay back the amount borrowed or the interest, in fact. That's not quite true. You could delay the interest. It just pushes back 1 year on the other. Redeemable, I will pay you back your money. So the question is, I'm calling them preference shares, and what tends to happen is people want to recognize both as equity, but they're saying, well, if it's redeemable and there's an obligation to pay this regular interest and pay back the amount of money at the end of a period of time, it is most likely to be considered a liability, and therefore you should recognize it as a liability, and the interest you're paying yearly, you should recognize as a finance cost. Right. So, and here, of course, when you now pay any interest on these irredeemable preference shares, you can call that dividend and recognize it accordingly. Right. So IAS 32 really guides us because you can see recognizing something as equity or liability clearly defines gearing. Yes. And the risk associated with borrowing. So it's really important to get that right. IFRS 9 recognizes or discusses measurement and recognition. And 7, of course, discusses the disclosure. So we'll talk about, I think that's a good introduction. So what we'll do in this next video is come along in the next part and talk about financial liabilities. And when I say financial liabilities, in our syllabus, the key financial liability we'll be looking at really are our loans and technically debentures and bonds. But they're all very similar. The same principle applies to all of these. The fact that how do we recognize a liability, a financial liability? So we have borrowed some money over a term, and how do you recognize, if you like, that amortization or that growth of that loan until when we finally repay it? Given that we wish to do good practice by accruing, if you like, the loan over a period of time. Remember, we're just borrowing money now, but we will pay back that money with interest over a period of time. We may be paying back some of the principal, we may not be, but the question here is, how do we kind of arrive at that balance? Okay, so I'll see you in the next video.